put the spotlight on Raymond. We have Mr. Amit Agarwal, who is the Group CFO at Raymond, joining us on the show. Very good morning to you, sir. Thank you so much for joining us on ET Now. Let's talk about your quarter gone by. It was a strong one. Overall growth was largely aided by the real estate segment. So do you expect the strong booking momentum to continue even in the current financial year, that's FY25?
As a group, we have got three verticals, which are lifestyle, second is a real estate, and third is in engineering. You have seen, in spite of the challenging market conditions in the lifestyle business, which is the retail is not doing so well over the last whole year, except for a short period around Diwali time. The weddings have not been so strong. However, we still have been able to show a year-on-year growth on our apparel business, because as we move forward, we are doing more on casualization, the premiumization, expansion of the retail footprint. We have opened more than 200 stores in the last year. That has led to a branded apparel growth. And similarly, also, if I look at the real estate, as we continuously keep on adding projects after projects, be it Thane or the one which we launched at JDA, has helped us to grow to a booking level of almost 3,300 crores in the last year. And the engineering business, let me talk about that, because that is the acquisition of Mining Precision, which we did almost at the end of March, which for the whole year you did not see any revenue and profitability of that. But that business, again, has done extremely well for us. If I look at it, the revenues they have delivered is almost 900 crores with 140 odd crores of EBITDA. And going forward, there is a big growth driver there. So I believe that all our three cylinders, so to speak, are firing very, very well. We have great opportunity. The market is very, very good. That in the real estate, there's very good sales potential and the kind of the products which we deliver. Similarly, on the lifestyle business, as we progress on the demerger part, and which is the 9th of May, we have the NCLT hearing, final hearing on 9th of May, we will have demerged lifestyle entity. So I think the future is quite bright for the group.
All right, all cylinders firing very well. Hi, good morning, Amit. This is Shrishti also joining in. One of the segments that the street is really excited about is your real estate segment. And earlier you had mentioned the annual revenue guidance of 3,500 to 4,000 crores from this particular segment. Will you be still sticking to the guidance or any upgrade there?
Look, I had always talked about over the next 3 to 4 years that we would hit that kind of numbers. And we still maintain that. We are very confident that this should be achievable. If I look at this juncture, I have a 25,000 crore potential alone from a Thane land to be built over, let's say, 8 to 10 years, of which 9,000 crore is under construction. Similarly, at the same breath, we have signed more than 5,000 crore worth of JDA projects. 3 JDA projects have been signed. So to that extent, and the one at Bandra we have launched. So I feel very, very confident that achieving a 3,500 crore to 4,000 crore revenue over the next 4 years is absolutely feasible. And we are well on track for achieving that.
Right. 23% growth in the branded apparel segment. Has this growth momentum sustained so far in Q1 of FY25 as well?
I would not like to specifically talk about the Q1 because Q1 is impacted because of the significant heat waves which are going through. So people are not stepping out so easily to come and shop. Second thing also, what happens, Q1 normally used to have few days of wedding, and this year the number of days of weddings are very, very limited. So that also puts people not to go out and buy. But I think overall as a year, and we have always talked about that over the next 3-year period, we intend to double our apparel business with a kind of retail expansion. We have already opened new stores of more than 200 new stores, and we plan to open another 350 to 400 stores over the next 2 to 3 years. So I think very, very clear journey. And let me talk about our ethnics, which has been a very, very bright spot for us. We have opened more than 115 stores. As we stand today, we have 115 odd stores, and the product is very well accepted. So I think coupled with our branded Park Avenue, Raymond Ready to Wear, Color Plus, Parks, as well as the Ethnics by Raymond, we see a great opportunity in this segment that we can double the revenue on the branded apparel over the next 3-year period.
Amit, your branded textile and garmenting business, which contributes around 46% of your top line, there the growth has been a little subdued. Any early signs of revival, or are you looking to enter any new geographies to propel the growth out there?
So look, in terms of, let me first talk about branded textile. Branded textile is a main business on fabrics, which is the suitings fabric as well as the shirting fabrics. The suitings and the shirting fabric, and there's a lot to do with the wedding related purchases. Now, the last year, the wedding related purchases has been little muted, and therefore the impact has been that the growth has been marginal. However, what is important is to note that our focus on cost rationalization, product mix, development is so strong, innovation is so strong that we continue to, in spite of all challenges, we continue to maintain the margins. The margin profile continued to be very, very strong. Similarly, on the garmenting front, you look at it, I think we have been able to grow the revenue. Only in the last 2 quarters, there has been not such a stupendous growth on the revenue because of 2 reasons. One, in the 3rd quarter, there were some issues about the delay in shipment. And now in the 4th quarter, what happened, the Red Sea crisis has really pushed a lot of our volume. And that has created a little bit of an impact in terms of revenue recognition. But at the same juncture, we are very, very bullish and strong that our growth and capex, which we are putting in the garmenting business, as we talked about earlier, that we are putting almost 200 crores of capex in this business, and which will make an increase in the capacity by 1/3, taking us the 3rd largest suit maker in the world. And the China Plus One, I think over a next 3 to 4 year period, we are seeing this revenue to grow at least 15-16% year on year CAGR over the next 4 years. And the margin improvement, you should also see that there has been a margin improvement in the garmenting business. And I think our focus is also to see that we want to create stronger businesses. Maybe we will have a very clear path for a profitable growth. We don't want a growth which will lead only a revenue growth but does not deliver me profits. And I think that is exactly, if you see every business, we have become stronger, sustainable, long-term, profitable player.
Right, and on the top line, you have actually been growing pretty strongly, but margins are taking a hit, and this you could attribute to increased investment in the branding and the advertisement segment. Will you continue to invest in this segment heavily in FY25 as well?
So I think that's a very good point. And actually, this is not the first time I'm saying. I have been repeating saying this, that we believe as we progress in the branded apparel towards the premiumization part and the casualization part, telling the world that otherwise Raymond was considered more a very formal brand. Now, if you're moving into casualization, it needs to be communicated adequately. And therefore, we believe that every year compared to the normal spend on ad, we should be spending anything between 60 to 80 crores every year incrementally for the next 3 years on the ad, so that people become aware. As we continue to expand the footprint, we are already present in 600 cities. But we believe as the city is becoming larger, as things are progressing very well, our country is becoming so strong, the economy is growing so fast, I think what we need is to provide the shops, provide our EBOs right in the vicinity of a customer. And therefore, we think that between tier 1 to tier 4, there's a great opportunity for the retail expansion, which will continue to be open and adequately advertised so that these kind of products are available. And therefore, we are very clear that we are not looking for a quarter to quarter, as I talked about earlier also, that when you asked a question about the quarter 1, that we believe that we will create a long-term, sustainable, profitable businesses. And we are on the journey. And if you see, the margin improvement consistently has been brought into the apparel business. What it used to be 3 years, 2 years back has consistently improved. Similarly, we see in the garmenting business, what was the last year or the year before earnings or the margins has consistently improved. And I think we do not want to say suddenly a big spike and then drop. We want a consistent, slow improvement one year after year.
All right, Amit, with this, we'll let you go on that. Thank you so much for joining us today on ET Now. So that was the management of Raymond's taking us through how are the earnings this time around and also talking about all the three growth engines of the company right now and sharing its growth guidance as well. But with
If you like this video, then like, share and subscribe to ET Now.